All right, welcome back to Around the Desk, where we dig into markets, companies, and big questions behind the numbers. This is a post-mortem edition, so short, quick, simple, to the point. I'm Sean Emory, Chief Investment Officer, co-founder at Avory Co, an asset manager here in Miami. So let's get into the topic, Metaverse 2.0, Meta post-mortem. Today's topic is really just around Meta's Q3 2025 earnings. Revenue was up 26% year over year. The street was low 20s, so a big beat on that end. Buy side was somewhere around, a little higher than kind of consensus on the sell side. The biggest acceleration here among any of the mega caps in terms of growth, outside of Nvidia, of course, the stock fell on the news. So what's happening here? First, let's talk about some of the numbers in general, some of the engagement metrics. Meta came in strong, really strong report overall. 51.2 billion in revenue, up 26%, ad impressions up 14%, and price per ads up 10%. So healthy numbers across the board. If we look at some engagement metrics, time spent across Facebook, Instagram was up double digits. Engagement metrics also accelerating, not slowing. Very, very key to the story here as we move on. If you look at user numbers, you saw family of app users now hitting, 3.54 billion people, and that's growing 8%. So growing 8% on such a large number, half of the world, that's, a astonishing figure. And again, half the planet engaging in Meta, what seems like every month across, Facebook, Instagram, WhatsApp, Threads, and the entire ecosystem. And yet the focus isn't on growth after this earnings call. It's really on the spend. So let's dive into that quickly. Operating expenses now somewhere around 116 to 118, so 117 billion at the midpoint. That was guidance. And then CapEx moved up. They moved up the lower end from 66 to 70 and kept the top end there at 72 billion. So at the midpoint, you're talking CapEx for the full year at 71 billion. This somewhat implies, again, forward going into 2026, approaching, if we keep, some sort of linear growth rate here, $100 billion in 2026. I think the street's, closer to 98. Management, I think this is where it got a little bit questionable in terms of what people were looking at is, they highlighted how CapEx will be notably larger, expenses will grow significantly faster. So typically, I would say 6 months ago, you got credit for that, specifically on the CapEx side, on the AI CapEx side. This time, I think that's where investors may have hit a pause. Again, this is short-term versus long-term thinking, but, I was just on Bloomberg TV earlier today on this recording, and they asked the question, everyone's thinking, is this kind of the metaverse story where, if you think of the last time they were in hyper-spending mode, the market punished them for that. It may have left a mental scar, but I think a scar that's not warranted. And I'll talk about why. So are we repeating kind of history here? And, yes and no. Yes, meaning we're spending, no, meaning the implications. But back then, Meta was all in on the metaverse, a visionary, probably early on that bet, with limited ROI, totally fine, depending on the environment. This time, they're going all in on AI infrastructure, different technology, similar narrative, heavy spend, uncertain payoff. But I think here's where distinction, matters in that view. Meta is seeing returns. I'm making that clear. You just look at the numbers, turn on the tape, and you can see that Meta is seeing returns. They're embedding AI across everything from the personalized feeds to automated ad generation to creative optimization to the recommendation engines. Their AI Advantage, product, to put some context, is now running at 60 billion annualized revenue run rate. Advertisers are seeing 14% lower cost per lead. In my world, that's real return on investment, not theoretical. So that's important to think about. Now, the question though is, why is the market potentially reacting, differently now to the increased expense relative to, let's say, 6 months ago? I think the issue isn't, the fact that they don't believe in AI. You look across the market, anything that is AI related has been working to some degree. Most of that, gravitating towards, Nvidia, let's say. It's that Meta seems to have removed the ceiling on spend. And ultimately, I think that is the only point here that matters. Zuckerberg said directly he'll invest as much as it takes to lead in AI. And in investor language, that means near-term ROI discipline, somewhat out the door. We've seen this playbook before, though. You go back and you think of Waymo, which was once criticized for being a science project, now leading in autonomous, and now they're getting some credit for that. The difference, though, is, Alphabet's CapEx obviously didn't double overnight. And again, it's all about that ceiling that seemingly got removed from Mark's terminology as opposed to what was given, which was guidance, and they capped the ceiling on that. So I think that's why we're seeing maybe some pushback. But if we're being fair, Meta is executing revenue growth of 26%. Again, second only to Nvidia among the large caps. And remember, they sell ads. They don't sell AI infrastructure in an AI frenzy. So they're selling ads in an environment where everyone says the consumer is weak. Advertisers are spending more on Meta. I don't think that happens because people suddenly love Meta again. I think it happens because the engine is improving, better personalization, again, better recommendation systems, better advertiser ROI. That's AI infrastructure paying off in real time. That should be the focus if you are a midterm, long-term investor, even a short-term investor. 26% growth in a consumer ad market. I don't know how that distinction is not clear that something is driving that. So while the ROI, let's say on like their AI glasses and some of those other things are still early on, even though Mark on the call did hint to the point that their new Orions could be profitable at some point in the near future. Their AI glasses with Luxottica are performing very well. They get sold out really quick. So there's a lot to like there as well, but a much smaller business relative to the size of their monster ad business. But the broader point, I've been talking a lot about this lately. The biggest near-term risk to markets isn't geopolitics or even the consumer. It's CapEx discipline. All this AI spending will start to flow through income statements soon. And those budgets, as they rise, the revenue growth needs to justify it. And it just gets harder over time as you continue to ratchet that up. If the market starts pushing back on CapEx at all costs, we could see ripple effects downstream from, clearly the hyperscalers to the chip makers to power and data center infrastructure plays. So the question is, are we starting to see that shift? Maybe, but right now I still think it's all systems go for the AI investment. You listen to AWS, you listen to anyone in the ecosystem. It doesn't sound like anyone's slowing down. But, if the market does, force them to slow down, I think you could see that. But look, Meta's story is on fire. That's the reality, 26% growth. The company, in theory, there's nothing wrong with the story at all. They're no longer maybe being rewarded for some of this CapEx spend here in the short term. But again, they have to justify it with continued growth. And the irony of all this is their core business has never been stronger, but the market is asking, how much is too much? And that, I think, is the clear takeaway in this post-mortem for Meta. I'll see you later.